Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Here's the right guy to talk about the partial derivatives of the algebraic function known as American GDP. He majors in physics for Mr. Peck and the crew at Morgan Stanley. Portfolio Solutions Group CIO Jim Caron joins us right now. Which of the alphabet soup of the function matters? The consumption, investment, government, or NX?
Thank you, Tom. Well, look, I think all of it matters, but right now I think consumption probably matters the most.
70% of GDP, roughly.
70% of GDP. It's something that what we're looking at today is really about the strength of the consumer, the jobs data, all of that stuff is going to matter quite a bit. That's been probably the most surprising element of this period of time is that we've been able to bring the inflation rates down, but the jobs data has actually stayed relatively strong, which has kept surprisingly strong GDP numbers.
Does the yield space, Paul's on the 2-year 5% yield, does the yield space describe Ellen Zentner's economics?
You know, I think it does. It's just really a question of, like, if we have the 2-year yield flirting with 5%, that makes sense in an environment where we believe the Fed may only cut possibly one time this year. And that's really indicative of the strength, and we're going to see what the first quarter GDP numbers come out to look like in the next 4 minutes or so. But what's also very important about that, though, is really tomorrow's PCE number, the inflation number. So good growth, like 2.5% growth potentially, as a potential growth, or 2.7% is what's expected on the Bloomberg surveys for PCE, and for GDP it's 2.5%. If that growth number is good, that's fine as long as inflation's low. But if inflation turns out to be high with strong growth, then the Fed has a problem. The Fed has no problem with strong growth and low inflation. Full employment, strong growth, stable prices, that's what the Fed wants.
So what are the good folks at Morgan Stanley Investment Management doing in terms of getting positioned here for a Fed that I guess the market's now come to the conclusion, as you mentioned, they're not going to be cutting it as much here. What do we do? Yeah,
so I think really, the key element here is when we manage multi-asset portfolios across fixed income and equity, one of the things that we have to think about is how do we use bonds to hedge equities? And one of the conclusions that we've come up with is that you may not want to be as long duration in periods of potential turmoil, like the correction that we're seeing in the markets today in equities, as much as you had in the past. And the reason is that I think that the bull market in bonds, in my view, has ended. We're likely to go sideways in a range in interest rates for a long period of time, in which case having extra long duration in your portfolios these days is probably not the most optimal.
Put some numbers on that. I mean,
sure.
Muni bond people, short duration's 20 years because they're all yield hogs.
No.
Well, give me a year statistic instead of this baloney duration.
Okay. Yeah, no, good point. And it's good clarity to add. So the aggregate index for the U.S. is about 6.5 years of duration. So that's generally what people think of as neutral duration. What I would say is that you might want to be somewhat underweight that and have maybe somewhere on the order of like 5 to 5.5 years of duration. So just slightly lower than index duration, I think, is a more optimal hedge against the broad returns in your fixed income and equity portfolios. Now, that may be financial market heresy to say, go underweight duration and it reduces risk, because typically people think adding bonds and adding duration is what reduces risk. And that's historically been true, but that's been true in a bond bull market and may not be so today.
I'm with Mr. Caron on this, to say the least. We're 90 seconds away from a hugely anticipated GDP number. Let's review this. The quarter ends 12/31, and they take a month to get it out. So now the quarter ends 3/31, March 31st, and get out your calendar, in 4, 5, 6 weeks along, we get the first look at GDP. And I thought Veronica Clark was good, Victoria Clark. It's Citigroup, of saying recently the first look, the second look, the third look have been pretty smooth. It hasn't been adjustments. So I think there's even more weight here. The Atlanta GDP number, Paul, 2.7%. The Bloomberg survey, 2.5%.
Yep. So, this economy, the growth has slowed, but this growth is still there. Inflation's coming down. Yes, it's still sticky. But you put all that together, and as Jim was just mentioning, it kind of suggests this Fed doesn't have to get over its skis too much.
I'm glad we got the GDP price index. 1.6% was a prior, and it explodes up to a 3% number here. We're going to see in 15 seconds. There's also core PCE price index, but then don't confuse that with the inflation data that we see tomorrow. It gets a little confusing. Jim Caron will explain that if he stays around here. It's Bloomberg surveillance. Here is the data coming out. We get trade data first. It's pretty much a little bit larger deficit, but I'm not going to go. Wholesale inventories, I don't understand. Solid. Claims is a terrible number. Are you kidding me? 207,000. And now we get the GDP statistics, and this will be market moving. 2.5%, the survey, it comes in diminished. Jim Caron, 1.6%. Personal consumption, lighter. GDP price index, 3% is 3.1%. And core PCE price index, I guess I'm going to say explodes. Maybe that's too large. 3.4 up to a 3.7% statistic. And the VIX launches here. The 2-year yield, 4.92%. I think there's enough wow here just in the headline numbers where there's almost confusion in the market.
I think there is confusion in the market. We're seeing the S&P futures weaken a little bit here, down about 1% on the S&P. And just looking at the short term of the yield curve, 2-year Treasury is up 1 basis point, 4.94%. But again, the GDP annualized quarter on quarter, kind of the headline number, 1.6% growth there in the first quarter. Consensus was 2.5%, as Tom was mentioning. And I'll also highlight, prior period was 3.4%. So if you're looking for a deceleration in the economy, this data certainly kind of bears it.
Chris Yancey driving our coverage for Top Live, and he says simply 1.6% growth rate is lower than any of the 59 estimates of the Bloomberg surveys, of course, except Jim Caron. He nailed it. But what we've got is a deteriorating market. NASDAQ off Facebook, 1.3% as well. I'm watching the 2-year yield, 4.94. Yes, it's gone green. We have a higher yield there, 4.95%. Yeah, really starting to move. Like there was almost a 30-second delay there when the data came out, Paul.
People are just trying to grasp it here, but again, as Bloomberg Live, we're just following the reporting. Bloomberg Live, really. It's talking about a significant underperformance there in the U.S. economy, finally starting to slow. And you think about the long and variable lags of the higher rates, maybe we're seeing it in the
fascinating. We'll get to Jim Caron here in a moment. Our economic indicators each and every day, 7 days a week, but particularly important days like this, brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit Commonwealth.com to learn more. Jim Caron, the numbers, I think, had enough shock factor. And, I've been doing this a few years. The markets didn't move for 30 seconds. It was like stunned.
Well, this is a big miss. And like you said, many economists, nobody really had this number. This is, look, one of the big positives of the first quarter was that there was a narrative that we were just growing very, very strong. And this is unwinding a lot of that narrative. So now this is actually a very friendly number for the Fed.
Yeah.
Because what the Fed has been saying is that we're going to get this economic cooling, and we don't have to worry about potentially these inflation numbers that have been coming out hotter than expected, that it's all going to correct itself. This is a major step in the right direction. It starts to put June back on the table.
You think so? Okay.
Potentially, it puts June back on the table. Now we're not seeing that right now in terms of the price action of treasuries. Now, of course, everything's going to depend on, is there a revision to this? Was there some type of an anomaly? We've got to go through the numbers. We have to go through the math of this whole thing. But but effectively, a slowing like this is going to bring down some of the inflation angst that's been in the markets.
Yeah, I mean, I think it's really interesting. I was looking at the WIRP function to see how that's going to start reflecting any changes in the market's expectations for the Fed. And you're right, it seemed like the market, we started the year with 6 cuts potentially. We got down to, 2 or even fewer than 2 just as recently as yesterday. And maybe this will cause the Fed to maybe think about being a little more dovish.
And there's one other thing that I really want to bring up,
Please.
because I think this is very, very important, is that earnings expectations are highly linked to GDP growth. So I know we're talking about the bond market a lot. Let's talk about the equity market just for a second here. If earnings growth is slower in the first quarter, that's going to change a lot of people's full year earnings estimates for 2024 and potentially even going forward. So the equity markets are actually responding more strongly on this because it's basically making many analysts take down some of their robust earnings expectations.
Jim, I got 8 ways to go here, but let me go to what I learned in school. The textbooks. You have physics envy, which is why Caron's here. And the answer is you got to hang your hat on one thing. And to me, it's the 10-year inflation-adjusted yield. And forget about the math, and let's not impress people with a log. On a semi-log basis, I'm getting out to a real stress point at 2.26%.
Yeah, the real yields are certainly moving higher, and to the point where this has historically demarked a bit of a slowing of economic activity. But none of this is happening in synchronicity to the extent that one of the things that we're also seeing is the prices paid components and the pricing components of the internals of the GDP number are actually causing the bond market a little bit of angst here. So on one hand, we have a weak headline print. On the other hand, we have some inflation and pricing pressures. So in theory, inflation is a lagging indicator. So inflation should fall on these things, but unless there's something that's just going.
Well, what's Ellen say? Stop. I mean, you got a team of 14 people. Karen's there with 2 interns. They're from Bowdoin. But Ellen Zentner's got like 25 people. What do they say about the disinflation vector at Morgan Stanley?
Yeah, so look, I mean, it's as Ellen likes to put it, it's going to be a slow, bumpy path lower. So, inflation is likely to come down. It's just a question of does it come down in a linear fashion where people are comfortable with the pace. But the trajectory, nobody's really disagreeing with the direction of inflation. Most people agree that it's coming down. It's just a question of, is it coming down fast enough for the Fed to start their rate cutting cycle? And that's the debate. So what Ellen pushed out in terms of her Fed forecast was from June to July, that the first rate cut would start to come in July. And I don't think that this number might not change that in many ways.
Okay, is there an inertial force here right now? Are we getting to where there's enough yields or truly on a physics basis? I make jokes about it. But seriously, are we getting a weight towards an inertial force of higher yields?
Yeah, so I think, as you were saying earlier, many people came into this year overweight fixed income, long duration, and this has been correcting. Now, the positives around this is that at this backup in yield, if you're looking at a multi-asset portfolio, you can start to think about owning U.S. Treasuries. You can think about owning bonds, high-quality bonds now, as a reasonable hedge against your equity, and you can actually potentially get some return from these levels.
Sweeney's going to get his 5% 2-year yield and a cup of coffee. Out on YouTube live chat, James with a real smart insight. Stagflation, Jamie Dimon nails it.
Yep.
I mean, that's really what we're talking about. I mean, you mentioned David Weston. He's going to be with Professor Summers, and Larry's going to pick it up and go, here we are. But, I mean, that's what the research papers, Paul, are going to look like. Jim Caron, one more question, then we're going to go to Dr. Wong, and we're going to bring Jim Caron back after Dr. Wong.
Hey, Jim, I'm looking at the 2-year, just today, up 6 basis points, as Tom said, with 4.99%. And you've mentioned fixed income as a hedge for equities. That did not work in 2022. That 60-40 portfolio did not work for anybody. Is that still something you guys think about? Is that still something we should keep in our toolbox?
Yeah, I mean, we have to think about how we use bonds to hedge. And the idea was that you could passively buy fixed income and it would just represent a great hedge. And this is one of the reasons why I think you should hold less fixed income exposure in terms of duration to hedge against your equity portfolio. So to have slightly less, like I was saying, 6.5 years of duration is the index average. That's what's considered neutral. I'm saying you should have maybe 5 or 5.5 years of duration. So I do think we need to think differently about this. We have to remember that for 40 years, from 1981 to 2021, bonds were in a bull market. Today, I think they're largely going to move sideways.
Okay.
So your expected returns are really the coupon out of fixed income.
Jim, let's finish up with you so you can go back and publish. What part of the yield curve will be most affected by sub 2% GDP?
So, look, in theory, what it should be is the 10-year yield. So in theory, the curve should start to flatten down, because if you have a weaker growth economy and it shows that you're going into a slow period and a slow patch, longer duration actually will be a reasonable hedge in that particular environment. So the front end right now, and I think the bond market is looking at one thing. That's the consumer side, that's the prices side. The equity market is looking at the whole picture, and it's looking at that 1.6 versus the 2.5. And I think that is that's the mismatch right now in the market. So right now we have bond returns and equity returns highly correlated. That's dangerous. High correlation is dangerous. So there's no place to hide, right? So if you bought bonds to hedge this number, you lost, at least right now at this point. But like Anna was saying, I do think that some of this bond sell-off will start to get reversed once it gets digested. Yes, it's imports are a very important component.
Paul and I got to make some news here today. There's no court. We got to make some news. Ian Lingen, and we're sorry we can't get Ian Lingen in from BMO. He's got to go into a Bank of Montreal conference call. But Ian Lingen has said at some point the 10-year goes price up, yield down. Is this the moment where we finally get a catalyst for a lower 10-year yield that, just as one example, brings mortgage relief across America?
So in my opinion, the answer is yes. I do think that 4.75 in the 10-year yield. I know we're kind of close to that right now. So let's say that we're just about there. I think that's a reasonable line in the sand to draw, and it's a place where I would start to take some bond risk.
Paul, round it up 4 digits. I know you want to jump in and round it up, Paul.
Yeah.
4 digits, 5% in the 2-year yield.
Exactly right. Hey, Jim, as you go back to your offices at Morgan Stanley Investment Management, you sit down with your PMs this morning. Are you guys going to change anything in your portfolios? Change your outlook, change your allocations? Think about it, maybe a world that maybe stagflation is something we have to think about.
Well, I don't know. I think it's a little early to call for stagflation, but so we've moved more towards a neutral posture at this point. So we've taken our equity from overweight to underweight end of the first quarter. But I think in bonds we are going to start to take our duration up a little bit higher because these yields are appetizing. So that's likely the next move for us.
Go ahead, Paul.
No,
one more question to Caron. Jersey's having a tantrum.
I know.
It's take your daughter to work. Did you bring any kids in? No.
My kids are too old.
My kids are too old. I go to Afterthought today. I go, do you want to come into work with Dad? She's looking at me like, is it that or go to Eli's on Madison Avenue and chat on $25 at cheeseburgers?
Exactly.
What you going to do? Elena's waiting. Paul, get a question.
Jim, real quick, what do you think the Fed's going to do looking at this data today?
So I still think Powell's remarks from a week ago still hold. I think he's still waiting to see more confidence. We still have to see those inflation numbers come out softer consistently.
Yep.
Yeah.
This has been great. I really look forward to talk about triangulation. I'm going to blame Steve Roach for this. Maybe there's somebody else. They fight like cats and dogs at Morgan Stanley. They've got my greatest respect. The next meeting of Karen Zentner and Mike Wilson.
Oh boy.
That's going to be. It's going to be.
We should do a remote broadcast.
We should do a live broadcast. It's like the NFL draft. We'll have to see. Jim, Karen, thank you so much, particularly for coming in today. Greatly appreciate that. Perfect person, perfect time. Constance Hunter joins us, working with Julia Coronado at MacroPolicy Perspectives. Constance, I want to go to the I. I want to go to the business spirit, given sub 2% GDP with an inflation impulse. I have a 10-year real yield back to 2009 levels, where it pretty much sustained 2004 to the crisis and then 2009. Does the higher inflation-adjusted yield, does that begin to impinge now on American business?
Well, that is the question, Tom, and I think it has been impinging on American business, right? When we look at financial conditions for those who can access the capital markets, financial conditions look fairly accommodative, right? We have higher equity markets, people are going to the bond market and issuing debt. When you look at financial conditions for households, when you look at financial conditions for small and medium-sized businesses, they are tighter. However, with that said, we are still seeing record new business formation. So there is something happening under the hood of this economy that is different than previous cycles. And as we know, history rhymes, it doesn't repeat.
Very good. Constance, obviously the market was looking for, if you look at consensus, was looking for a slowdown in GDP in this quarter, but not this slow. Does that change your thoughts about, I don't know, what the Fed will do, what investors should do, what you guys should do there at MacroPolicy Perspectives?
Yeah, well, as you can imagine, our Bloomberg chat has been very active this morning amongst ourselves and with our clients, right? So the view, of course, is this makes it a more difficult calculus for the Fed, and certainly that higher inflation number gives pause. I will say, though, if you think about, so there's two things, and they're not necessarily congruent things, because we're at a time when we're in an inflection point, and in inflection points, data gets very funky, right? And we've been pointing that out with some of the contradictions that we see within the labor market data, both the official data and some of the web scraping that we're doing with regard to company intentions to hire and fire, right? And so what we have here is we have stronger services consumption, which quite honestly, I think economists have been waiting for that outside services consumption for several quarters. And goods consumption just persisted in being strong. Finally, we have the decline in goods consumption. That means that in all likelihood, this low to negative pricing we're seeing in goods will continue. That will give some relief to overall CPI.
Constance, I want to talk, Constance, about the bigger picture. The mail, and Paul gets all the love, Lisa gets the love notes, Constance. I get hate mail. And the hate mail I get is simple. You guys are nuts. Most of us feel like it's a recession, and we're getting crushed by inflation. If we have a run rate sub 2% GDP, and the fancy people are living large, what portion of America now is in recession with an elevated inflation rate? It's got to be, what, half the country?
Well, that's an excellent question, and I have to delve into the numbers to give an exact figure. But you bring up a very good point, and as you know, every time we get the CPI numbers, I do a table that shows the annualized pace of individual components since February 2020. And while, yes, the month-over-month pace seems to be doing better and the year-over-year pace is doing better than the height, what people are anchoring to is that cumulative increase that they have to pay. And they can't get out of paying things like, for example, like vehicle insurance. It's not easy to substitute. Homeowners insurance, not easy to substitute. And these really do take a bite. Now, with that said, on vehicle insurance, it looks like that was a one-off. 3 state regulators, California, New York, and New Jersey, allowed insurers to increase the vehicle insurance price. So that looks like it was a one-off, but still the mood is that it's hard to control where price increases are coming from, and there continue to be rolling surprises.
Bloomberg Surveillance, we always go to anecdotal evidence. Joining us now, Paul Sweeney with a hate mail from New Jersey. How bad is the insurance story?
It is. I mean, it's crazy here, but that's just, one of the many costs of living in
these are fixed costs. These are not like variable costs. I mean, it's like Hamburg. Very quickly, here, data check markets deteriorate. SPX a negative 1.3%, NASDAQ negative 1.7%. VIX is actually pretty quiescent, still under 17, 16.86. And that 10-year real yield, sum it all up 6 massive basis points, 2.29%. That takes us back to 2009 and even back to 2006.
And Tom, read headline across the Bloomberg terminal: traders push back timing of first Fed rate cut to December. Constance, do you even maybe take it a little bit further and think about, is this the Fed even contemplating a rate hike? Is that something is possible?
I don't think we're ready for a rate hike because one, concomitant with this weaker growth is going to be weaker jobs data. So we pushed back the first rate cut to September, but I really think there's a case for we get up to 5% on the 10-year before this is all over.
Interesting. All right, Constance, thank you so much for joining us. Constance Hunter, Senior Advisor, MacroPolicy Perspectives.
Jon Stolzfus of OpCo. Jon, how do I stay in markets on days like this?
Well, thanks for having me on the show, Tom. I've got to say this. I think the question, that traders ask right away is that should I go or should I stay? Like the old hit song. And there's a passing fancy potential here, capricious nature of the fast reaction. But for investors who are investing for anywhere from 2, 3, 5, 7 years forward, out, it's a quick moment to pause and ponder, check out the babies that are getting chucked out with the bathwater, whether it's in technology, industrials, consumer discretionary, and a host of other cyclical stocks in particular. We'd have to think is worth checking the opportunity that's available, because the trend, we believe, is our friend, and the trend is led by the Fed, which has acted incredibly responsible this Fed funds hike cycle, reflecting what we call the Ben Bernanke legacy.
Yeah, Jon comes on, the market's negative 600, and he lifts it down to negative 580. He's a force.
Exactly. Hey, Jon, what do you think, some of the reporting coming out and some of the words coming off of Wall Street this morning is maybe calling into question whether the Fed will cut at all in 24. How do you think the Fed's going to look at some of this data? And then, of course, the important PCE data tomorrow.
I think we'll have to see what happens with that data tomorrow. I think when Mike McKee was talking, he really had some important spots to consider there. But what I would say is this is effectively, we came into this year when a lot of people were expecting, I think it went from, it was 5 to 7 up to 11 cuts. People thought the economy was falling apart, apparently. We looked at it. We thought the Fed was going to cut likely 2, which rubbed up against the Fed's 3 sort of intimated cuts that they were talking about early on. And I think they still had that. Who knows where we're headed in terms of the near-term commentary. Right. But we've got to say, we think the economy, as was mentioned earlier, the consumer is good. Business remarkably resilient, we're still early in the earnings season, but some things have been good.
Okay, I'm going to make the observation that money market funds are going to become more comfortable here. Sweeney's on the 5.02% 2-year yield. That's going to be comfortable here. And you're going to tell me, but share buybacks are going to click in. Are share buybacks to the rescue of the market?
I don't think it's just share buybacks. I would think it really has to do with the fact that earnings and revenue, particularly earnings growth, has been significantly resilient, and revenue growth hasn't really, on an idiosyncratic basis, it can surely disappoint. But overall, it shows a resilience that is maintained, which likely tells us corporations are better, and naturally so after 15 years of successive crises, at navigating tougher environments. And with AI, just where AI is today, not where it's going to be in the future, this is likely what's going on.
EIEIO. Paul, Stolzfus' crater in the market, negative 620 on the Dow. Stolzfus' fault.
Jon, I know you guys took your year-end price target up to, I guess, 5,500 on the S&P. What's kind of the driver? Is that an earnings-driven market, or is that a Fed-driven market? What are the drivers there?
It's a combination of the two. It's a combination of the Fed. It's earnings-driven. It has to do with innovation, and it's as we saw the rally from late October of last year, broadening to the other sectors, expectations that innovation will feed into other sectors other than technology and consumer discretionary and industrials. And within that kind of a feature, the nice thing is you have several things playing. It's not it's a fundamentally a better story towards a normalization where bond issuers pay for the privilege of borrowing money. Bond buyers get something in return. It hurts the fast crowd, because they like to be highly leveraged, and they will protest the Fed's reluctance to cut rates drastically. And I think Powell does not want to. He certainly doesn't want to be Arthur Burns, and he doesn't want to have to become Paul Volcker again. I've been doing this. I came in during the period where Volcker was beginning his second term, and so I've lived with the Fed through 15 years of Greenspan, and Greenspan was almost a science project.
What is this, a therapy hour?
He was living with inflation that was sticky.
We're almost to negative 700 in the Dow. Go away. Jon Stolzfus with us from OPCO. We really look forward to his research report from Oppenheimer and Company. He has been in this market. He has enjoyed a multi-year bull market. Your daily look at the front pages, and because children are in the building, they're appropriate stories today. Lisa, what do you got?
All right, yes, we're keeping it PG for the kids today. Okay, so we've heard a lot about a lot of workers being afraid that AI is going to take over their jobs. That's a big thing. But we had one IT company who's telling the Financial Times that technology could do away with call centers. You have a lot of the call centers. This is the head of Tata Consultancy Services, said AI is going to result in, they definitely know, especially over in India. Quote, minimal need for call centers as soon as this year, as soon as a year. And so it's going to show that it's going to have a vast industry across Asia and beyond.
But you know how they shove you to chat? You do chat, and there's no person on the other end. It's just a computer algorithm. It doesn't work. That's my sophisticated analysis.
It's frustrating. You're sitting there, you're like, representative. Like, I just want to talk to a person.
Why is this going to work?
Well, they're saying that what's going to happen is that the chatbots are going to be able to analyze the customer's transaction history and do much of the work that are done by those call center agents. So they're saying they're not going to need them.
I need some new Tang Zero right now. I love sending a message into our control room telling Michael, the lazy puke, sleeping right now, because it's take your children to work week, go get me a coffee and a Tang Zero. It's about time we put these kids to work. What's next?
So we're talking about kids. We're talking about girls. I love this. It's a girl power story. Sorry, here we go. Okay, the Queen's Park Ladies. It's an under-12 soccer team in England. They are undefeated. They're playing in a boys' soccer league. Nice. Okay, so they're kicking butt. They're hoping to inspire younger girls to get into the sport. They've won all 22 matches. And at first, the boys were laughing, when they saw these girls come out. And who's got the last laugh now?
You know who's behind this? You know who's behind this?
Who?
Mohammed El-Arian.
Oh,
I have told,
really?
we were out having a beverage in London, me and Jon Ferro and Dr. El-Arian. And we're, the two of us, we're trying to get him to pick up the tab. And we're saying, Doctor, he did pretty well in the investment business, folks. And we said, Mohammed, would you just buy QPR? And he's trying to decide, should he buy QPR, which is in the Champions League, or should he go big? Yeah. Like the league, buy Arsenal or whatever. But the QPR ladies are getting it done.
They are.
The under 12, very cool.
Yeah, but I thought
morning,
that was
Mohammed.
really cool. Yeah. And the reason they did is because when they first started years ago, there wasn't a girls' league. Yeah. So they didn't have the competition. So that's why they joined the boys.
They didn't have a girls' league?
It was about 6 years ago when the club started. Yeah, and they didn't have a girls' league back then. So.
Well, girls' sports here. I mean, your daughter's huge.
Girls' sports here are really big. Yeah. I know when I was younger, I was an athlete. I played with the boys on the basketball team.
Did you?
They didn't have middle school girls.
No, stop. How many D1 schools are going to recruit your daughter?
0.
She's like huge. No, she's like
She'll
huge.
She'll go D2, D3.
Okay.
D1 is tough. But and it's a big workload with the school and the D1 schedule.
She hit a ball the other night, which landed in Staten Island.
She did another homer. She did.
Okay.
I'm telling you, girl power, love it.
Girl power.
So since we're talking about kids, a new report says U.S. birth rates actually fell last year to the lowest level in more than 40 years. So this is from the U.S. National Center of Health Statistics. It fell 2%, 3.59 million. Not just the U.S., birth rates in other countries worldwide. And we all know why. The experts are saying, paid family leave, skyrocketing healthcare, childcare costs, it's all the same. But peak birth rates shifted to women in their 30s and 40s. Those rates declined in 2023 from the year earlier.
So my Four offspring. That's an
You are
unusual,
a rare case.
Okay, it's just being
People
Irish
are
Catholic.
not having
is, I think,
4
what's going
children
on.
anymore.
I think it's the
Hopefully
one
do.
thing. The one thing
It's
I
the
learned
money.
in the pandemic, other than listen to the medical pros. Thank you, all the people that saved us at Moderna and Pfizer as well. The number one thing I learned is we lived all the evidence that our child care system is broken.
Yeah.
We all lived it.
We did.
Everyone.
Yeah, the child care is crazy. I mean, Matt Miller during this time came back from Germany where they have paid child care, and and his wife was just shocked that we don't have that here in the U.S. She said, "Wait, this is the United States. You guys don't have paid health care, so women can go to work and do all that kind of stuff." And then during the pandemic, of course, it became that much more.
Deal. Huge deal. Are you done, or is there one more?
No, this one's for you. Now, I know you like your Doc Martens, Tom.
I do.
But this is a new thing you may have to switch to, okay? It is a snowfer or a sneefer.
I saw this.
Okay? It is a cross between a sneaker and a loafer. All right, so New Balance is coming out with it. It's in August. It's kind of looks like a sneaker. It has a grayed out mesh, but it has no laces. So they're hoping that this is different from, the slip-on shoes, different from that. This is more high-end, so they're hoping
I'm
it'll
not
go
going
to the
there.
executive. You're not going to wear it.
Here's where I got really disappointed. One of my all-time favorite people who I look up to, David Weston.
David Weston
always
wears sneakers.
dressed to the nines. He is now with his wonderfully tailored suits coming in. I mean, he's a player.
He is.
Wearing these kind of sneak things with his suits. And if David Weston can go casual,
Michael McKee
the
does
world's
it too.
coming to it. Michael McKee again, another one.
I'm rebelling.
I'm just
You
not
can't
going
do
there.
it?
Do you know, in the hallway at the front door where Mrs. Keene says, "Shut up and throw this out," she has my last pair of decent Bauer skates. Like they're just below like what the NHL people wear, and I think they're going. I'm not putting those on again. I don't think so. But are you going to get me in old fart sneakers without laces?
We're
I'm
getting
with
you
Paul
the
on this.
snowfers.
Yeah.
I may have to hire somebody to. Michael Rainier, do you want to come over and tie my shoelaces? It'll be great.
That's true. You don't have to tie the laces; just slip them on.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.